right, everyone, what's your view?
The Investment Committee is the final peak to ascend in our investment process for private credit at MA.
This is the point at which our investment and portfolio management teams jointly put forward a proposed credit deal for inclusion into one of our managed funds.
One, we think it is a high quality underlying business.
It's already a high bar for a deal to get to IC. To make it to this point, the investment would have been through many weeks, or often months, of extensive debate, due diligence, research and analysis. At the IC, it's a bit like game day in sports.
What's your recovery profile?
All the hard work and preparation has been done. The investment team is confident on the deal's merits, the portfolio manager supports the deal and is convinced it enhances the fund's portfolio.
Debt terms, pricing and deal structure have been negotiated with the borrower. Now it's decision time. But the IC isn't a pitch. This isn't about our investment professionals selling us on a deal to do.
It's a forum to collaborate with some of the most senior and experienced professionals within the MA business about whether the investment makes sense and to draw on their collective experience from many a successful and failed transaction that they have seen in the past.
I really wanted to get a handle on the lease exposure, the level of leverages associated with that, and actually if there is...
Our IC members come from diverse backgrounds and each bring a unique perspective to help us make smart lending decisions. Debate at the IC is more than just facts and numbers. It's about really understanding what you have to believe to make the investment and how in the real world the investment could play out.
I appreciate that contractually you can turn the capex off.
Sure.
But it does directly correlate with revenue and earnings.
It's a way to test our thesis, question and challenge and leverage the insights from our past successes and mistakes.
The important thing to remember in credit is that we are lenders, not equity holders. Our job is not necessarily to pick winners, but to avoid losers. We're the tortoise, not the hare.
I think I'd like to challenge the idea that it is as flexible as you've described.
If you observe one of our ICs, that's the thing you'll notice the most. We're intensely focused on uncovering what the downside risks are in prospective investments.
how are we actually exiting and working this thing out?
They'll look to split those up, sell them to either strategics or private equity funds.
Finding ways to mitigate those risks and ensuring we have real margin for error if things don't quite go as planned.
Sure.
I actually think it provides some interesting diversity to the book relative to what we've got now, so that's why. So I'm favourable of this.
I don't like cash. I know I'm comfortable with the black swans, so I'm probably tipping the other side. It's not a deal we need to do. The margin's not that great.
Our goal is to protect our clients' capital while delivering resilient income by making loans that we think represent an outsized return relative to their risk.
This is especially important for us because we're investors too. MA and its staff have over $150 million invested alongside our clients in our private credit strategies. You could say we eat our own cooking.